York this morning, just about 9:30.
Hello and welcome to What Goes Up,
New
the
York
J
this
Capital
morning,
Research
just
podcast
about
about global
9:30.
financial markets. I'm Ann Stevenson-Young. In this week, I'm speaking with Michael Pettis. Michael is one of the two or three people I most respect on China. His books, particularly The Volatility Machine and The Great Rebalancing, are some of the best. It's just phenomenal books, and books that have influenced me a good bit on China and also on understanding global capital flows. His bio, Michael is a non-resident senior fellow at the Carnegie Asia program in Beijing. He's also a professor of finance at Peking University's Guanghua School of Management. He formerly taught at Tsinghua University and before that at Columbia University. He spent the first half of his career in New York on Wall Street in trading, capital markets, and corporate finance. He worked with manufacturers Hanover, which is now part of J.P. Morgan, and Bear Stearns. He was a partner in a merchant banking boutique, and he also worked at Credit Suisse First Boston. I wanted to get Michael's views on the effects on the world economy of a declining China. That is a little bit of a complicated question because China's GDP was very robust in 2016 and 2017. So we took a fairly long detour onto the nature of GDP and what it means for China. I found it very interesting. The sound quality is a little bit uneven because the first part of the interview was cut off and we resumed the discussion in New York 2 weeks later. But I think it's very interesting. I think it's worth listening to. So I hope you enjoy it as much as I did. So I wonder if you could just give us a general sense of why you came to China and what you find compelling about China.
Well, as you may or may not know, I spent much of my career on Wall Street running trading desks or capital markets desks, focusing on developing countries, which, because I was always on the fixed income side, that was 80-90% Latin America. When I started, I came out of the Columbia Business School, and I desperately wanted to do Latin America. This was in the late 80s, and I actually got laughed at because, as Citibank told me, we don't pay Columbia Business School salaries to do Latin America. It's dead, and it's not coming back. But eventually I managed, by hook and by crook, I started off doing more traditional investment banking stuff, but I managed to get into the Latin American side in '87 against the best advice of everybody because I was going to destroy my career, apparently. But of course, Latin America came back faster than I expected that it would. I was very lucky there. But in the early days, every deal that you did had never been done before or hadn't been done since the 1970s. So, for example, the first private sector bond issue by a Venezuelan company ever in history was one that I did in, I think, 1990 or something. So there were a lot of deals like this. And it was very exciting because you really had to sort of reinvent the wheel each time. And that's what made it so exciting. You had to figure out how to structure the deals, how to sell them, how to get over a whole bunch of various issues. But by the late 1990s, I was running two groups, the Latin American Capital Market Group at Bear Stearns and a liability management group, which I had created. And the truth was that some of the liability management stuff that I did was a lot of fun, but most of the rest of the stuff had become very boring. Every deal had become a cookie cutter deal, and the best client was the client that every 4 months did exactly the same deal that he did the last time around, and I just found that incredibly boring. And so I figured I have to leave the street, and I wanted to go someplace that was very big, but about which I knew very little. And that sort of narrowed it down to China and India. It had to be developing countries, which I've always liked. And I'm not really sure why I chose China, but I did. And I was very lucky because I came to China in 2002, I think it was. Just before China really took off and sort of became, the biggest thing going. So just as I went into Latin America just before it exploded. The big lesson there is that on Wall Street, it's always better to be lucky than to be smart, and I really lucked out in my timing. The plan was to come here for 2 years and then return to Wall Street or something, because I'm a New York obsessive. But that was 16 years ago, and so far I plan to continue staying here for at least a few more years.
Well, good. I think China's the better for. Certainly the rest of us are. So let's talk about China. You've been talking about how China's GDP growth needs to decelerate and eventually drop into sort of the 1% region, and that's because it's so heavily debt-driven. And yet, over the last 2 years, which have been very political years, growth has actually accelerated. So do you think that that was really good for the world economy? To what extent do you think that that generated global demand? And should the world be concerned about a coming drop in GDP?
Well, it's not necessarily surprising that happened. What I argued was that implicitly what I'm arguing is that the whole concept of GDP, as we all know, there's a lot of problems with the concept of GDP. But in China particularly, there's a huge problem, and that is that GDP is typically a system's output. So, you go to the US or Mexico or Germany or whatever, and all of this stuff happens within the economy. And GDP is something that we've all agreed among ourselves we are going to measure as a proxy for the underlying growth in the economy, the growth in wealth or the growth in debt servicing capacity or the growth in productive capacity. In principle, these are all supposed to be the same thing. But in China, GDP is not a systems output, it's a systems input. That is, we get together, when I say we, I mean the leadership, not me. We get together and we decide that we're going to have a targeted GDP growth number for that year. And, miracle of miracles, we hit it right on, plus or minus 1/10% year after year, which in and of itself should open you up to a lot of questions, as I know you know. But what that means, GDP as an input, is that if you look at GDP growth in most other countries in which it's an output, the economy does what it does, and then we go out and measure certain types of economic activity and say that changes in that measure, growth or decline, represent changes in the underlying productive economy. And there are a lot of problems with GDP, as we all know. But on average, that's a reasonable statement. But from a systems point of view, when you use GDP as a systems input, it's a completely different number. It doesn't have anything to do with the GDP growth number generated by Mexico or Germany or the US. These are completely different things. Now, how does that difference work? Well, GDP is a measure purely of activity. As you know, we can build 2 factories. Let's assume they cost exactly the same to build and to operate. And one factory, let's say, produces PCs at a reasonable price. These are hotly demanded by the market. Everything it produces, it sells. The other factory produces electric typewriters. And of course, nowadays, nobody buys electric typewriters, so they simply accumulate as inventory until they rust away to nothing. Now, those 2 factories have very, very different implications for the growth of the economy. The first factory represents real growth in the underlying productive capacity of the economy. It's a good thing, and you want to include that in your GDP number to the extent that you want GDP to represent what's happening in the underlying economy. The second factory, I don't need to tell you, produces nothing. It produces nothing of value. It produces inventory which rots away to nothing. So it should not represent an increase in the productive capacity or the wealth of that economy. Right? If anything, it reduces wealth because it uses up resources in a way that are non-productive. A little bit like, remember the Great Leap Forward, steel production in China surged, but one of the ways it surged was they would take really good steel utensils and throw them into the furnace and produce steel that was totally unusable, which simply piled up. That shows up as GDP, astonishingly enough. The factory that produces electric typewriters contributes exactly as much to GDP growth as the other factory, the factory that produces PCs, which people want and buy and that are useful. So that, right off the bat, is a huge problem because both of them contribute to GDP in exactly the same way. And if we think that growth in GDP is a proxy for growth in the real underlying productive capacity of a country, then we shouldn't include the factory that produces typewriters, because it's not increasing wealth, it's not increasing debt servicing capacity, it's not increasing anything. But unfortunately, they both show up in GDP in exactly the same way. So there's a mechanism, however, that prevents that from becoming significant in most countries. There are two mechanisms. One is what we call hard budget constraints. As you produce all of these electric typewriters, you are generating expenses, but you're not generating revenues. So you can only do that for so long. At some point, you get forced into default. You simply cannot generate the revenues to pay for all of the expenses, so you go broke. Now, that's very important, because what that means is that in every economy, we do lots of non-productive stuff. But in most economies, our ability to do non-productive stuff is constrained by hard budget constraints. If you keep losing money, you can only do that for a few months or a few years before you go out of business. There are exceptions. So, for example, in Spain, I have to remember not to walk around. In Spain, before the crisis, there were huge amounts of useless apartments that were built up because of the real estate boom. So you could build a useless apartment and still sell it at a profit. That creates a problem, because that enters into GDP, even though nobody lives in the apartment or ever will. So sometimes when there are bubbles, for example, an economy can systematically ignore the hard budget constraint. But, in the worst case scenario, it's 4 or 5 years, and then you get the big adjustment when all of that garbage is written down to zero. So it shows up as negative GDP. So you return to the point at which GDP is a reasonable proxy for changes in the underlying economy. But there are some cases in which that doesn't happen. For example, the Soviet Union in the 1960s, when growth was so high that everyone knew that it would overtake the United States sometime in the 1980s. But it turned out, like in China today, that a lot of that growth was not real growth. It was GDP growth. But it was an increase in economic activity that did not create any underlying wealth or debt servicing capacity. And we have that problem in China today. There are no hard budget constraints for the public sector. There are no hard budget constraints for the public sector in many countries, but they're usually quite small. In China, it's huge, and in fact, more than 100% of the increase in investment in the last several years has been public sector investment. And that's where the problem originates, because, as I said, when you include as GDP things that don't really increase productive capacity, then there is a split between what GDP means and what we think it means. We think it means an increase in wealth, and it doesn't actually mean that. So if you have hard budget constraints, you can have that split between what GDP means and what we think GDP means for a few months, and in extreme cases for a couple of years in the case of a bubble. But in China, you've had that split for 30 years. In other words,
so let me stop you for a second.
Sure.
I completely agree, and it's a fantastic point about GDP and these sort of heroic targets that China keeps setting. But and lest anyone think that it's merely an analogy, exactly the analogy between or exactly the fact of the computer factory versus the typewriter factory really is going on in the property sector, where China is building building after building that's completely unused and that actually is a drag on the economy.
A quarter of all apartments.
Right. I mean, it's just...
A quarter of all apartments in China are empty, which is
exactly.
incredible.
I mean, all you need to do is walk through any city in China and you see what an incredible and sad waste it is. But it does drag along international demand because Australian mines are fulfilling the demand for the iron ore, and American factories are fulfilling the demand for tractors, Japanese factories, so on and so forth. So the acceleration in GDP growth in 2016 to 17, even if it's in a very limited way in the industrial sector, it did raise prices for international commodity suppliers and industrial suppliers.
It's real economic activity. I mean, there is real activity going on. It's just not creating value. But if somebody goes out and, let's say, Donald Trump gets his way and builds not just a wall between Mexico and the U.S., but between the U.S. and Canada too, and then destroys the wall, all of that is real economic activity. It doesn't increase the wealth of the United States. It would cause GDP to go up at first, and then either in the form of a crisis or in a long-term form of amortization, we would give back all of that fake GDP. But meanwhile, the guy who gets paid to build the wall is going to make money. It's just going to be money at the expense of other Americans, and we just won't recognize it for a few years. But it's real economic activity.
So that's what I'm wondering. We understand that China is building up a deficit, and that ultimately China has to sort of, in a sense, pay back all of that empty construction. But the coal supplier from the United States, the iron ore supplier from Australia and so forth, genuinely has sold real stuff, generated economic activity. So who's losing out besides the Chinese? And what is it? And if no one, then what happens if the Chinese actually do reduce investment-driven growth?
It's the Chinese who lose out because they are generating useless economic activity. They don't realize it yet because, let me get a little bit technical here. In standard accounting, you can spend money in the form of an investment or in the form of an expense, right? So if you take your client out to dinner, that's an expense. If you spend the same amount of money upgrading your factory, that's an investment. And the way they show up on the balance sheets are quite different. If you spend $100 on an expense, your cash goes down by $100. Your expenses go up by $100, so your net profit goes down by $100. And once you've got all of that recognized, everything is balanced, right? So the asset side of your balance sheet drops by $100 because you've lost $100 of cash, and that's matched by a reduction in your profits of $100. So assuming that you don't do anything else, you have negative profits of $100. So your retained earnings go down by $100. So your net assets minus liability, your wealth, goes down by $100. That all makes sense. Let's say instead you spend $100 building a useful factory. In that case, nothing happens to your income statement. What happens is that you reduce your cash on the asset side of your balance sheet by $100. You increase investments on the asset side of the balance sheet by $100. So there's no net change in your net assets. Your wealth is unchanged. Now, let's assume you decide to, for whatever reason, to treat your expenses as investments. So you take your client out to dinner for $100. But instead of recording the dinner with her as a $100 expense, you decide to record it as an investment. It'd be totally illegitimate, but let's assume you do that. In that case, your cash goes down by $100, as it should, but instead of your expenses going up by $100 and your net profits going down by $100 and your net assets going down by $100, none of that happens. Your cash goes down by $100, but your investment goes up by $100. So you have earned, from an accounting point of view, $100 more than you would have by treating this expense as an investment. And your net wealth, your assets minus your liabilities, would be $100 more. So by turning this expense into an investment, on paper, you have increased your income and you have increased your wealth, or your wealth hasn't changed. The reality is that your income is down and your wealth is down. But on paper, your income is up and your wealth is unchanged. Basically, that's what's happening. When you invest in a factory that produces nothing, that's an investment. You reduce cash by $100 and you increase your investment by $100. But then you recognize that it's worthless, so you write it down by $100. And on your income statement, there's an expense called the writing down of assets, and that expense goes up by $100. So the way we keep the books looking like reality is through the writing down of the worthless investment. You made a worthless investment. It should have been an expense because it's not really an investment. It's just throwing money away. And the way you turn it into an expense is you write it down. But what happens if you live in a regime where you never have to write it down? Well, in that case, you have all of these assets on your books. Each time you do this $100 investment, you have a new $100 asset on your book, but it's worth zero. So your net assets are much higher from an accounting point of view than they are in reality, and your income is much higher from an accounting point of view than they are in reality. Eventually, you will have to write it down. There's a whole bunch of mechanisms. You can either do so explicitly, the government can do it, or if you do nothing, it'll be written down over time. But you can postpone this for quite a long time. You can postpone this, depending on the structure of the economy, for 10, 20, 30, 40 years. The Soviet Union postponed it for a long time. Japan did too in the 1980s. And China's doing the same thing now. So for me, sorry, I had to take a drink. For me, the question is not whether this stuff is overstated and will eventually be written down. I think we all agree, if you believe that there is a significant amount of non-productive investment in China and infrastructure and apartments and whatever, then you must believe either that it is written down or that GDP overstates real growth and the total amount of assets overstate real wealth. In the former case, if you believe that it's written down, you should be able to point to the data produced by the central bank and show me. But of course, the data isn't there unless you believe there's a tiny amount of misallocated investment. The amount of bad debt that's being written down doesn't correspond to what you would expect if you believe that there is a lot of misallocated investment. So logically, the only possible conclusion you can draw is that GDP, which measures economic activity, overstates the real growth in underlying wealth or the real growth in underlying debt servicing capacity, or however you want to define it. And that all of the assets on the recorded amount of assets on all the balance sheets in China, private balance sheets, public balance sheets, etc., overstates the true value of those assets. So for me, the question is not whether Chinese GDP growth overstates real underlying growth. For me, the only interesting question is by how much. And I think it's very significant, very substantial. Partly for all sorts of anecdotal reasons. You can't get proof. You can only look at things that suggest that it's happening. And partly because there's nothing new about this story. As I keep trying to explain, everything that happens in China, and it isn't new. We've seen this many times before. And if we look at China is the third country in the last 100 years that was growing to grow so fast that it would overtake the U.S. within a decade or two. The first one was the Soviet Union, when everyone knew that it would overtake the U.S. in the 1980s. And the second one, of course, was Japan, when everyone knew in the 1990s or in the first decade it would overtake the U.S. When you look at the actual data, though, it's really astonishing what happened. Soviet GDP grew so rapidly that by 1967, 1968, the Soviet Union was roughly 15% of global GDP, which is more or less where China is today, a very high number. And if you were an optimist, you believed that within 20 years there would be 30% of global GDP. If you were a pessimist, you believed that they might be 20 to 25%. In fact, 23 or 24 years later, when the Soviet Union was dissolved, they represented something like 5% of global GDP. The story for Japan is very similar. At its peak, it was 17% of global GDP, sometime in 1991, 1992. And the U.S. was roughly 23%. And the real question is, within 20 years, will Japan be 23% or 33%? You know, that's where the debate was. Well, 20 years later, Japan was 6%. And I would argue that...
I think those are... Sorry, go ahead.
Well, to me, those are astonishing numbers. We should really be asking a lot more about why exactly that happens. And for some reason, we don't. We're not really shocked by that. And I would say that there's only two explanations. One explanation is after being really the best, most brilliantly managed economies in history, Japan and the Soviet Union, suddenly somebody pushed a button and they just became total disasters. It's a little hard to believe. The other explanation, and I always try to bring it down to whatever the logical explanations are, the other explanation is that the Soviet Union never was 15% of the world, and Japan never was 17% of the world. Its GDP was. But in both cases, GDP substantially overstated the reality. So
absolutely.
Maybe at its peak, there were... Yeah.
I think maybe let me tilt it a little bit of a different way. I think that if you were to believe that the world economy is a zero-sum game among different nations, then everyone outside China should be cheering for China's investment-driven GDP growth, no matter what happens within China. And I think those of us who have much of our lives in China have seen the deterioration of the quality of life as China has notionally gotten so much richer. But be that as it may, if you are in Brazil, Australia, the U.S., Canada, wherever, perhaps you should enjoy exporting as much as you possibly can in commodities to them while they drive GDP growth through this investment. Somehow instinctively that feels wrong to me because of ignored effects elsewhere. But what do you think about that?
Well, I think you're right. It's on the surface level, certainly in the beginning, you should be cheering it on. But over the longer term, not only is it terrible for China, but it's not really good for the rest of the world because it's all of this artificial demand which is being used to create assets that we believe are very valuable but that are actually worthless. It would seem like the world has benefited enormously from these Chinese mistakes. But I would say that no, that hasn't happened either because the way the world interacts through China, of course, is through the capital account and the current account. And so if China was splurging vast amounts of money into investment, China has, as you know, the highest investment share of GDP in history and the most rapidly growing investment in history. Normally, a country with a very high level of investment should be running a current account deficit because, as you know, the current account deficit is defined as investment minus savings. So here's a country with the highest investment rate in history. So whatever the savings rate are, it should be much, much lower. So China should be running a huge current account deficit. And that current account deficit would be net demand that China adds to the world economy. But as you also know, China's been running since 1993 a surplus, and in some years very, very large. So what does that tell us? Well, the current account is equal to investment minus savings. Investment is incredibly high, but savings is even higher. That's the only way you can have a current account surplus. Savings is extraordinarily high. And that's the big problem that China faces, because one of the big problems that people have, and even economists, which really shouldn't be the case, is that they think savings is what households do. So when you hear that China has the highest savings rate in the world, or when you hear that Germany has a very high savings rate, you say, well, yeah, of course. China is a Confucius culture, and Confucians save a lot of money. Germans are famously thrifty. But that's completely wrong. The reason China and Germany, but I'll focus on China, has the highest savings rate in the world is not because the Chinese people are particularly thrifty. They're like everybody else. But GDP is savings plus consumption. So the highest savings rate in the world is the same thing as the lowest consumption rate in the world. So the question is, why do Chinese consume so little? The automatic answer is, because Confucian cultures are thrifty. And as you know, Anne, that's total nonsense. The reason Chinese consume the lowest share of GDP, perhaps in history, is because they retain the lowest share of household income in history. I once heard a fund manager say, when the typical Chinese guy goes out and produces $100 worth of goods and services, he spends $50 and puts $50 in his bank account. No, that's not true at all. When the typical Chinese household goes out and creates $100 worth of goods and services, he or she gets paid $50. And so, of course, she consumes less than $50. Perhaps she consumes $30. And she saves $20. That's pretty good. But the rest of the economy saves $50, right? Businesses don't consume, and governments consume a little bit on behalf of households, but most of what they earn is not consumption, it's savings. So the reason Chinese savings are so high is because Chinese households retain among the lowest shares of GDP in history. So that's the relationship the rest of the world has with China, is that it produces lots of stuff and it demands lots of stuff, but it produces far more than it demands because of these huge distortions in the way income is distributed. So at the end of the day, the rest of the world doesn't benefit from all of this Chinese demand because on the supply side, the Chinese are simply unable to absorb everything they produce, so they must sell it to the rest of the world. And the rest of the world is already struggling with a problem of very low demand. And because of these surpluses in Germany, China, and Japan, and Korea, and a few other countries, they have even less demand because part of their demand is absorbed by these countries that are running surpluses. And if you'll notice, Anne, every country with a large trade surplus, it doesn't exist because households in that country are thrifty. In every single one of those countries, the household share of GDP is low or declining, most famously in Germany after 2003. So if you want your savings rate to go up, it's simple. Don't pay your workers. And that's what's been happening.
So what you're saying really is that this idea that China drove global growth in 2016 and 2017 is only true to the extent that Chinese trade surpluses came down, which they did. And although China may have contributed outsized profits to the industrial sector internationally and the commodities sector, the consumer and other types of sectors suffered. Is that the idea?
Yes. And, when people say that China is the biggest contributor to global growth, they're totally confused. China is arithmetically the biggest component of global growth, just as Japan was in the 1980s. But it isn't driving global growth. The way you drive global growth in a world of very weak demand is you add demand to the rest of the world. And China doesn't add demand, it subtracts demand. Now, we talk a lot about China, but really China is not nearly as bad as Germany, which is the biggest offender, or as bad as Japan. China has problems because of bad income distribution domestically. But these countries with big surpluses are not driving growth. They're simply arithmetically a big component of growth. But they're actually subtracting growth from the rest of the world. So imagine in 1990, you had the courage and the stupidity to say that that Japan was in serious trouble, and that for the next 20 years, its average growth rate would barely break 0.5%. Well, you would have been thrown out of the room as an idiot. No one would have believed you. But had they believed you, and by the way, that is what happened, but had they believed you, they would have said, well, the world is in serious trouble because Japan is the engine of global growth. And if Japanese growth drops from 5 or 6% to 0.5% for 20 years, that'll be a disaster. But it didn't feel like a disaster at all, did it? And the reason it wasn't a disaster is because Japan's connection to the rest of the world is through the capital in the current accounts. And the Japanese current account surplus actually contracted as a share of global GDP during that entire period. That's part of the process of rebalancing. So the crisis in Japan didn't feel like a crisis to ordinary Japanese households because Japan rebalanced. And it didn't feel like a crisis to the rest of the world because the Japanese rebalancing actually contributed or reduced the negative demand. And I would argue that that's probably what will happen with China. If China growth rates finally drop to where they really ought to be, which I think is 2 or 3%, it won't be a disaster for Chinese households if they rebalance, because you could have 3% GDP growth and 5% growth in household income, which is what rebalancing means. And it won't be a disaster for the rest of the world. It depends on what happens to the current account.
I'd like to start with understanding over the last 2 years, international growth has been fairly weak and China's growth has been very high. And the narrative has been that China has been really the savior of the world economy and driving world growth. So I want your view on that.
Well, I think that's based on an arithmetical misperception. China is arithmetically the biggest component of growth. But to be the engine of world growth really means to drive growth internationally, to drive growth abroad. And in that sense, what we need, what the world lacks is demand. There's insufficient demand. So the economy that drives global growth is really an economy that's creating demand. And we can see the net impact on Chinese demand through the current account. China, as you know, runs a current account surplus of between 1% and 2% of GDP. It may be twice that. There may be a lot of flight capital hidden in the numbers. But the point is that it is a net subtractor of demand from the rest of the world. So China is actually a drag on the global economy, a small drag, not as big as certain other countries, but it is a net drag on the global economy. That should change in the future as China rebalances and its current account surplus contracts. But for now, it is not the biggest component of global growth. Now, it may be a net drag on global growth, but that doesn't mean it's a net drag on everything. That's distributed very unevenly. China, of course, because its growth is still very heavily investment-driven, it creates huge demand for industrial commodities. So China is a source of growth for countries that produce industrial commodities, but it's on average, it's a net reducer of global growth, and so that means for certain economies, it is a substantial drag on growth, particularly economies that are importers of industrial commodities.
Do you have any idea about what's going to happen this year?
In terms of what?
In terms of that industrial growth.
Well, what really matters is the growth in China's GDP, because although consumption has become a growing share of GDP, It's a growing share mostly because GDP growth has slowed. Consumption itself hasn't really picked up. So what matters in the next year or two is GDP growth rates. If China keeps GDP growth rates up between 6 and 7%, then it'll continue to be a pretty significant demand for industrial commodities.
So, but the only way that we have to predict that is whether China maintains the current level of investment. Basically,
right,
that's
it.
Right. So, let's say it
maintains the current level of investment growth.
Okay. So let's set aside the question of whether that's possible and whether there's when you reach the debt limit and how you reach the debt limit. At some point, it stops. What happens to the rest of the world when that happens?
Assuming that China adjusts in a non-disruptive way, I think the same thing will happen. As China adjusts, the current account surplus will contract. That will be marginally net positive for the world, but it won't be evenly distributed. It'll be very negative for the producers of industrial commodities, but it'll be quite positive for manufacturers as long as they are not manufacturers in low technology, capital intensive sectors like ships and steel, where China is likely to continue producing and in fact dumping. Now, if China has a disruptive adjustment in the form of a crisis or something like that, then all the bets are off, because in that case we could see imports drop much more quickly than exports. In which case, the net demand that the negative net demand that China adds to the world would actually increase along with its current account surplus.
And don't you think that that's given the demand for capital flight that we see when the economy is in doubt in China, and there's some political events that have made perhaps elites more nervous now, don't you think that a currency adjustment in that case would be required, and then we'd see imports drop?
Not really. I've never believed that we were likely to see a sharp drop in the value of the renminbi. I think the renminbi is probably slightly undervalued. And more importantly, I think the central bank understands very clearly the role of the renminbi in the rebalancing process. Countries that have undervalued currencies tend to have high savings rate because a depreciating currency transfers income from consumption to savings. Now, if China were to depreciate the renminbi, it would reverse the rebalancing, the little bit of rebalancing that it's done. It would increase the savings rate and reduce the consumption rate, which is the exact opposite direction of which it needs to go. Now, of course, if you see significant flight capital and reserves drop by another trillion or so, at some point, the PBOC may decide that it can no longer defend the currency against flight capital, in which case it makes sense to drop the value of the currency. But we would need two things. First of all, we would need to see a real resurgence of flight capital that drives reserves down very low. And secondly, we would need the PBOC to be very confident that a depreciation in the renminbi, a one-off depreciation in the renminbi, is credible. The worst thing that could happen is that they allow the renminbi to drop, say, 10%, and rather than slow down capital outflows, that actually cause capital outflows to increase.
So maybe you could string out a little bit the secondary and tertiary consequences if we do see that downturn, not a crisis downturn, but a gradual grind down toward 1% GDP growth. And okay, so we see the commodities exporters with less commodity exports. What happens to currencies, to property markets, et cetera?
Well, one thing about China is that although it seems very connected to the world through the trade account, there are actually pretty substantial sort of walls between China and the rest of the world. So an adjustment in China is not likely to have a huge global impact. Everyone thinks it will because it's such a large economy. But again, it's worthwhile to go back and think about Japan. Japan was actually a larger share of the global economy than China is today. Japanese growth dropped to 0.5%, which is very low. I'm pessimistic about Chinese growth rates during the adjustment, but I don't think they'll drop that low. But the point is that what many would have expected to have had a very significant impact on the global economy didn't really have that much of an impact. During the 1990s, we didn't pay that much attention to what Japan was doing to the rest of the world. And China may be different, But again, I don't think it'll have as big an impact as many expect.
Okay. Well, what about the argument that China could go into a 20-year stagnation period like Japan's?
Well, I think, the longer it takes for them to get their arms around credit growth, the more likely that is to happen. As it is, I think we should expect it. People think that the optimist argument is that in the next 10 to 20 years, China will go from 15% of the world to 30% of the world. And the pessimist argument is that China will go from 15% of the world to only 20% of the world. But I don't think that's the pessimist argument. If you look at countries that followed similar growth models, the Soviet Union in the 50s and 60s, Japan in the 70s and 80s, both of them economies that grew to 15 to 17% of the global GDP, something roughly where China is today, both of which were expected to overtake the U.S. within a decade or two, widely expected. Those two countries, 20 years later, lost between 60 to 70% of their share of global GDP. In other words, the pessimist argument for China is that it goes from 15% today to somewhere between 5 and 10% in the next 20 years. Now, a lot of people think that's unlikely, and maybe it is, but we shouldn't discount it altogether.
And what does that mean for the Chinese people, for life within China?
Well, again, Japan is really interesting because GDP growth rates dropped from 5 to 7% before 1990 to 0.5% after 1990. And again, one of the predictions you would have made had you expected that is you would have said that the Japanese people will revolt. I mean, it'll be very difficult to accept such a collapse in growth. And in fact, the Japanese people didn't. They didn't even vote out the ruling party until the end of the 90s. And the reason I would argue is because Japan genuinely rebalanced. Before 1990, GDP growth exceeded the growth in household income. After 1990, the growth in household income exceeded GDP growth. So while GDP growth fell off a cliff, the growth in household income declined a little bit, and much of that is explained by the change in demographics. Japan had a growing population before 90 and a shrinking population after 1990. We could easily see something like that happen in China. For me, a best case scenario, and I think it's pretty optimistic, but at least it works arithmetically, is that GDP growth drops to 3%, 2 to 3%, but household income growth drops to 4 to 5%, which is pretty good. Most countries would kill for that level of household income growth. So if China can rebalance, it can support much lower GDP growth because household income growth will exceed that.
And is that's sort of an optimistic outlook for, in fact, the rest of the globe, if that's a possibility?
Yes.
Because I guess I would observe that that capital asset inflation cycles have driven economic cycles much more over the last, certainly since over the period since the global financial crisis than before. And I think we can probably agree that asset markets in the United States are also excessively valued and probably on the way down, at least at some point, and that could lead to an economic downturn. But it sounds to me like you think that's actually probably a good thing.
No, I mean, it depends what you mean by good. Over the longer term, probably good. Over the short term, it could be painful. But I was in Berlin yesterday with a group of people focusing on policy. And one of the points that was made, which I think is completely correct, is that what the U.S. really needs is fiscal policy to drive growth. But fiscal policy hasn't been driving growth, so we've relied on monetary policy. And the way monetary policy does that, the way it creates demand, is through the wealth effect. By expanding the money supply, you hope to increase the asset prices. And as asset prices go up, we all feel richer and go out and spend more. Well, that does work, but it's a really risky way of doing so because it's likely to inflate asset bubbles or overpriced assets. And I think it's hard to argue that assets are not a little pricey.
Well, it also leads to a tremendous wealth gap now.
Yes, it worsens the wealth gap, which is why it's a policy that works, but it gets weaker and weaker over time.
So talk a little bit about your new book.
Basically, what I want to argue in that book is that if you take the savings investment framework to think about trade issues, you come to some really seemingly counterintuitive conclusions. One of the most important is that what really drives the trade surplus and trade deficit in countries like the U.S. is the capital side. As you know, the capital account and the current account must always balance to zero. And implicitly, we always assume in our models and in our policies that it's the trade account that moves and the capital account simply finances whatever the trade deficit is. But that's simply not true anymore. That was true 150 years ago. But today, capital flows to the U.S. are completely independent of the current account or of the trade account.
Oh, so you're going to so the new book is about those balances, those trade balances and financial capital balances. Good. Do you have a title yet?
No, that's the last thing that happens.
And do we know when it's going to come out?
Well, I'm hoping that it comes out at the end of this summer, but I think that may be a little aggressive.
It sounds so. Yeah. Well, thank you very much. I think we can end it there. I know you're tired from all these flights.
Great. Well, thank you very much.
Thank you for doing it.